Let's get right to it. Ray, people who know you, who follow you, know that you've developed models to explain how the economy works, and anybody who's even remotely familiar with Bridgewater knows about the machine, for example, knows about the importance of the business cycle, and furthermore, the importance of the long-term debt cycle. What are those models telling you right now?
Well, let me just take a second and just review the model so everybody knows. So I'm saying that over a period of time, productivity matters the most. What you earn is what you can get to spend. But around that, there are two debt cycles. There's a short-term debt cycle that lets you spend more than you earn over a short period of time, but when you pay back, you have to spend less. And there's that cycle, the 5 to 8 year cycle, is the business cycle. We're used to that. Everybody understands that. And then there's a long-term debt cycle that goes on 50, 75 years, and it goes through its limitations. When you have too much debt relative to income, so you can't service it anymore, and when interest rates go to zero, so there can't be stimulation, we have run out of monetary policy, number one, and we have to go to monetary policy number two. Monetary policy number two is quantitative easing. This happened in the Great Depression. Happened recently, and that means the purchase of financial assets by the central bank, and the sellers of those financial assets then buy other financial assets, and they cause those other financial assets to rise in price and have the effect of lowering those expected returns. And when those other expected returns are low in relationship to cash, one is almost indifferent. And so when you buy that bond, when the Fed puts that money in the system, that person is going to then go it's indifferent. And that's called pushing on a string. And pushing on a string began in 1935, and we're going into a situation which is generally worldwide somewhat analogous to that. So
we're there again.
We're approaching it. So if I just take country by country now, if I could give you
a world tour.
A world tour.
Let's do that quickly.
Okay. So Japan was there first.
For a couple of decades.
For a couple of decades, pushing on a string, because they hit interest rates at zero.
And now they've embarked on the most aggressive quantitative easing program the world has ever seen.
And they're trying to stimulate to get 2% inflation, and they're going nowhere.
It's not working.
And it's not working.
So what's
Europe is there.
Okay.
Okay. Europe, if you look at the across the curve, we have interest rates at zero or slightly negative, depending on where. Okay. So interest rates is certainly not going to work. And then the purchases of those financial assets are getting transmitted in currency movements and the like, and the effect of raising those assets is very limited. So we're there in Europe, very close to being there in Europe. In the United States, we have a little bit more room. We're very close to zero interest rates. And then if you take the spreads are relatively low. So a little less than a 2% bond yield. We think equities expected returns probably are around 4%. So there's some spread there, some ability. The issue is if that creates asymmetric risks.
To the downside.
To the downside, meaning tightening is always going to be effective. It's easy. You raise interest rates and things will slow down because everybody's got a lot of debt. Not a problem. The situation is the risk on the downside, because if you have a movement on the downside, it's a risky situation. So we're going to have to see, and you'll see increased exploration of the movement to make other forms of stimulation, which I'm calling monetary policy 3. Monetary policy 3 will not be just through quantitative easing. Quantitative easing by financial assets from people who have it, and it stays in the financial community. We're going to have to move toward, increasingly, the making of purchases that put money directly in the hands of spenders. Because the linkage between having money in the financial assets and having spending is becoming weaker and weaker.
Can I just pause for a moment?
Sure.
So what you're effectively saying to me is that monetary policy 1, interest rates, has sort of run its course. It's become ineffective. Monetary policy 2, quantitative easing, if I take you correctly, ineffective. Central banks are now going to have to print money and hand it to consumers?
In one fashion or in another. They're going to have to go more directly to spenders.
How does that work?
Well, it can work in either a combination of fiscal and monetary policy. There's a continuum of how it's worked in history. In some cases, you can have the federal government run deficits, which the central bank essentially monetizes by lending them money, and that's one path. And then there's a continuum. And on that continuum, the far side of that continuum is called helicopter money. What helicopter money means is the process of essentially putting it directly in your hands. The central bank has the capacity, legally, to essentially get money in your hands. There's a legal, the laws change from place to place, to put it directly in your hands to have you spend it. In other words, to bypass the financial markets to do that. So there's a range of ways that can be done. History is loaded with them. We're just not acquainted with them because they haven't happened in our lifetimes before. In other words, these long-term debt cycles come once a lifetime, and people are not...
Once a century even.
Once a century even. So they're rare. But if you go back over history and you see them, they've happened many times.
So let's look a little more short-term, because that's going to take some time to play out, I take it, and examine what's going to happen in the next little while.
Good.
You have been saying for some time that you anticipate the Fed's going to have to ease again and possibly even embark on a new round of quantitative easing.
That the next big move, there'll be minor moves, like you may get another 25 basis point move, but the next...
Up, you mean?
Yeah,
or
you
down?
could... Up.
You
could see another 25 basis point rise in rates. I'm not saying that you couldn't see. I just want to be clear.
Yeah.
The next big move, I believe, will have to be toward quantitative easing rather than a big tightening. You won't see a big tightening.
So the next move could be up, could be down.
Yeah, the tick. Yeah, you could get an uptick. The next
as early as a couple of weeks from now?
I don't think. I think that they'd be I've always said, and I continue to say, I think it would be a serious mistake. I think that the Federal Reserve has come around to the notion that we're living in a world economy and that the circumstances that are now happening are surprising them, have surprised them, because they're not paying enough attention to the long-term debt cycle. In other words, there's a reason that their attitudes have changed.
Okay.
And I think it's great that their attitudes have changed about that risk. But if you look at around the world, our risk is not inflation and our risk is not overheating economies.
Okay, so you still feel the same way about the trajectory of the Federal Reserve and its monetary policy. If the the risks that we've talked about, if they're asymmetrically to the downside for the global economy and for the effectiveness of monetary policy because of this compression of the spread between the return on fixed income, and risk assets, what does that mean for asset prices?
Well, it means that asset prices correct to a point where the risk premiums come back.
In other words, we've seen a little bit of that.
That's right. In other words, the correction that's happened in the stock market. Let me be clear. I'm not bearish on the stock market.
No?
Oh, no, I'm not bearish on the stock market. I'm saying that what we have is, as you have those risk premiums, let's say I expect probably stocks will have about a 4% return. In other words, long-term return, 4%. That's a problem for a lot of savers. But nonetheless, the choices are...
And pension funds like the university we're at right now.
Yes, and pension funds and a lot of savers. It's a big problem that is like a slow-growing cancer because it will not happen overnight, but it'll mean that we won't have enough money to fund those things. But nonetheless, investors make a choice of assets, and the choices are cash, which has 0 return, a bond, which has less than 2% return, and equities, as we calculated, has something like a 4% expected return. So when you look at those assets, what would happen is as they sell off, it has the effect of making those assets more attractive and then draws us in or draws others in. The issue here that we're dealing with is the possibility of the negative feedback loop that comes from that and the ineffectiveness of monetary policy. So when stocks go down, and it has a negative wealth effect, that has a negative effect on the economy. And when that has a negative effect on the economy and you don't have the ability to ease, what I'm worried about is should the situation become weak enough in the economy, like Japan's situation, for, like you said, 2 decades, you will have a situation where then they have to do something else.
Ray, I'm going to take this opportunity just to remind everybody that this is Ray Dalio, of course, the founder, chairman, co-CIO of Bridgewater Associates, and we're simulcasting live on Bloomberg Radio, welcoming everybody to the conversation. Let's go beyond stocks. If the long-term average annual return for stocks is 4%, and obviously it's less for government bonds and cash at the moment, and for the time being is 0, what makes sense as an investment strategy? What do you buy? What do you short effectively? I mean, broadly speaking, what's going to work?
Well, I think,
and what is working perhaps more appropriately today?
I think there are 2 ways that the average investor should think of investing. One is, are you going to create a good strategic asset allocation mix that is a balanced portfolio? That means that you're not going to go to the betting table and bet against active investors like me. Look, I'm scared of being wrong in the markets. It is not easy to win in the market. It is more difficult to win in the markets than to compete in the Olympics.
Hang on a second. You guys have an extraordinary track record of winning.
Yeah.
Is it harder to compete in the markets today than it has been since you founded Bridgewater?
No, I don't think so.
Really?
Not the way we do it. And the reason I'm saying not the way we do it is we don't take systematic biases. I think for a lot of people, they're systematically long everything, And so we have a world in which when the world gets bad, it's bad for them. In 2008, it was great for us. I don't know, we had nearly a 10% return in 2008. So we have the opportunity to go either way. We just may be wrong if we're wrong. So I'm so scared about being wrong that it has helped reduce my chances of being wrong because I'm so scared. I won't take bets that that I don't feel good about, and we diversify our portfolio, and that's how we have the track record. I was just commenting in terms of,
I see.
Let's say, you asked me about investors. So I'm trying to go back what investors should do.
Well, and what you think is appropriate for
so
your
here's
investors, what you guys are doing.
Well, I want to just convey to investors. I think in the average investor, most everybody, don't compete against pros like ourselves or other people. Don't making tactical asset allocation bets or moving around in the markets because you're probably going to lose. It's difficult for us.
Just buy beta for 15 basis points?
No, you have to have a balanced portfolio. In other words, think about how you're going to have a balanced portfolio. What you know is that asset classes as a whole, over a period of time, are going to outperform cash. Okay, that's the most thing that you could be most comfortable with. If they don't, you have a depression. The only times that hasn't happened. But to know how to achieve a balanced portfolio, and that's a whole other subject I don't know that you want to go through. If you're talking about tactical bets, in other words, I can come on the show and I can say, I think this is good. But then what happens is if I come a month later and I then change my mind because something has happened, then I'm going to mislead people. So the tactical bets I don't think are going to be helpful. I would say that we're in an environment in which it's very important to have a well-diversified, and that'll include assets like, to some extent, maybe a little bit of gold in your portfolio. In other words, what could I tell investors? Try to achieve balance in various ways. That's a whole subject about how to do it. And also, I think that, gold, at 5% of your portfolio, 5 or 10% of your portfolio, under the circumstances, would be also a prudent thing to do. Prudence is the important thing to do. The reason I'm also referring to that is we have a situation where a debt is money. In other words, we have a fiat monetary system, too. And so we're having problems as these central banks operate. And so think of it as another form of cash. And when cash now has 0 or 0% interest rates or less, think of it as one of those possibilities in terms of how do you create diversification?
I respect the fact that the tactical view needs to change if you're going to be an effective investor, but I would like to get your tactical view on 2 things, if I may.
We'll see.
Oil?
No, I'm not going to give you my tactical view.
China?
Okay, I'll give you what my thoughts a little bit on China. I think China is going through a situation which is very similar to what the United States and other countries have gone through a number of times, which is that there's a debt problem. Debt is rising too fast. Just apply the template. You can't have debts rise faster than your incomes for long. Okay, so
Eventually,
that's what's been happening.
You run out of room.
And so you just apply the template to China. So they have to have a slower rate of debt, and they're going to have to restructure debts, and they're in the process of doing that. We've had 3 major debt crises in the United States, and we've done that each time. They have to restructure their economy. They have to have a different kind of economy. The old industries are out, and the new industries have got to come in. This has happened to us many times. I remember when it was a steel industry, and we were heartbroken because we would lose the steel industry. So we went from manufacturing to services, and now for services we're going to digital technologies and so on. They have to restructure their economy. That's a difficult thing to do. And they have a balance of payments challenge, a balance of payments issue. In other words, flows. We have had 3 balance of payments challenges and flows. So we have a situation in China which is very much analogous to those cases. And there are good ways to manage these things, and there are bad ways to manage those things. And the leadership matters. So, and I would say that from my contacts, contact that I've had over there, that you have very capable people in leadership. The stock market handling was not capable. Don't mistake the stock market handling for the capability of restructuring their debts. The processes that they're going through, and so the leadership.
So you have confidence.
I have well, you have the way I've described it a long time. It's like China is having a heart transplant. So if I said you're going to have a heart transplant, here's what, you probably are going to be fine in the long run. It's probably going to weaken you, okay? And it has to be well executed, and it's somewhat of a difficult situation that is going to weaken you, and you will get through it, and you will be better than you were before. I think that that's what the situation in China is. I think people who've exaggerated it one way or another. There are people who've looked at it as a boom, or there's people who've looked at it as a disaster that's going to total collapse of the system. I think they're missing actually what's going on.
Do you feel, you mentioned the stock market debacle that we witnessed in China last year, and how that's not necessarily terrible, but not reflective of how the leaders are handling the economy. Based on what you've seen, do you feel better about their ability to handle their debt situation now than you did, say, 6 months ago?
Probably about the same. The balance of payments issue is going to be a challenge. Let me, if you want to get into the balance of payments, I'll explain it just a little bit. But the balance of payments has to do with the currency. A lot of money leaving the country.
Yes.
For
and they are draining the reserves very quickly.
That's right. Well, because money's leaving the country, and also these cycles happen every place. Yeah. But what happens is when the money's leaving the country and less money wants to go into the country, it creates a balance of payments issue. In terms of that money leaving the country, they have a lot of control over that nature of that money because a lot of those are state-owned enterprises and other things. For example, they've just opened the bond market to foreign investment. We estimate that probably in maybe 18 months or 2 years, that'll be worth about probably in the vicinity of maybe $200 billion of inflows. In other words, you could have, by opening the bond market and having foreign investors invest in the market, it will also attract money in. Many of their companies are state-owned companies and multinational companies, and they have greater controls over than we might think for ourselves, and so on. So while there's a balance of payments challenge there are also ways to deal with that. I'm not saying it's not a challenging situation. It is a challenging situation. But the tools to management, and I would say the capabilities of managing it are excellent. I will say that I get to know different economic leaders around the world in different ways, and I would say that their capabilities are equal to the best that exist anyway in terms of the things that need to be done, which are monetary fiscal policy, restructuring debts, I mean, all of those types of things. And there is an advantage. Look, there are a lot of disadvantages to a system like that. But one of the greater advantages is that there's also greater controls over things.
Do you think to fix this balance of payments issue you've described, they'll have to devalue their currency?
I don't know. I guess the thing that I would say is there's a balance of payments pressure. It's one of those things where it's too close to call. The tools that are there are really great in many ways, And then it's just one of those too close to call situations.
When we go back to what you were describing, the failures of monetary policy 1, interest rates, the failures of monetary policy 2, quantitative easing, the possibility of monetary policy 3, where somehow governments get cash directly into the hands of consumers, does that augur, what does that augur well or poorly for? You know, if you're thinking as an investor.
Well, if you're thinking, there's the economy and there's the investor. I was going to answer the economy part of it first, but you've asked from the perspective of the investor. From the perspective of the investor, I would use Japan as being more of what is more likely, unless there is a debt restructuring to deal with these things. Meaning, we've raised the limits as to debt relative to our incomes as a group. There's the private sector, there's the public sector, but let's take us as a country, then take us as a world, so include Europe, take China, take the whole world. The world has a limitation right now in terms of you can't raise much debt, so we can't borrow our ways to higher spending. With the zero interest rates being down there, that's where we are. And then in terms of returns, we're going to have a low return environment. And that low return environment is the main issue. That becomes the main issue.
But when you liken it to Japan, Ray, and I just want to remind everybody who's watching, again, Bloomberg television viewers and Bloomberg radio listeners worldwide, does that mean that the United States and Europe, the developed world, broadly speaking, of course, Japan is part of that, but is that the trajectory? Is that the road that we're headed down? That we're looking at?
Loosely speaking, I believe that that's the most likely scenario, meaning slow growth, very slow growth.
Deflation.
Ups and downs, okay. The increased difficulty in stimulating monetary policy that was manifest in deflation. The movement toward increasingly other alternatives, ways of having monetary policy that will produce stimulation. More currency volatility. But in other words, I'm not expecting something like 2008, because 2008 was a debt crisis. There were a lot of debts coming due, and they couldn't be paid, and that was what 2008 was. This is not like a crisis situation that way. It's not one of the, I don't think we're going to probably see the big bang crisis type of thing. I think that what we're going to see is this kind of situation in which there's the dynamic of a relative stagnation, low returns, and also the, not much picking up and low returns and stagnant and volatile markets, choppier markets probably over a period of time. So because
like what we've seen thus far at the beginning of this year?
Yeah, it's because as you have the zero interest rates and then you have the market sell-off, then the market sell-off brings back risk premiums, and there's a lot of liquidity. And so from an investor point of view, okay, then you might move out from something like cash or a bond or something to an asset like equities, and you might move out. And so you have this movement up and down as those risk premiums change.
But investors en masse have to decide that those risk assets have repriced enough to create an attractive enough spread between...
That's right.
Are we there yet?
Well, no one knows exactly what that range is. I think that becomes the nature of it. And then we have to see whether there's that negative feedback loop.
I see.
Okay, because that part of the negative feedback loop is, in other words, stocks go down, and that then means the wealth effect is lessened. And as the dollar goes up, and the wealth effect is, and that makes us less competitive. Both the rise in the value of the dollar and the decline in the value of stocks is essentially a tightening of monetary policy. And globally, there's a tightening of world economic activity. And those negatives, how exactly they pass through to the economy is the asymmetric risks that I'm referring to.
I see. Ray, while you're sitting here, I want to touch on something that I know is important to you because it's attracted a little bit of attention lately, shall we say, which is Bridgewater's culture. Mm-hmm. And the attention that it's attracted is due to this notion that there's some kind of a dispute, if you will, between you and your co-CIO, Greg Jensen. Give me a sense of what's going on behind the scenes. But culture is,
okay.
That's why people are asking questions about it again.
Okay. the way that we succeed is by having thoughtful disagreement. When I'm so scared about being wrong, and the key to my success and our success is to try to find people who disagree with us, who are smart, and try to understand their point of view so that we can have disagreement. In order for us to have independent thinkers, there's going to have to be disagreement. And you have to be able to disagree well, and you have to have those processes. You also have to know what your strengths and weaknesses are. You've got to bring all the weaknesses to the surface. This is the essence of the culture, and people, they say it's all very
what you've laid out in your principles.
That's right. So you have to bring all weaknesses to the surface. You have to bring all of these things, individual strengths and weaknesses, and you have to work yourself through that in a thoughtful way. That's how we succeed in the markets. That's how we're succeeding, and that also builds our community. In one sentence, what we want is, our goal is meaningful work and meaningful relationships. The relationships part is just as important as the work part. Meaningful work and meaningful relationships through radical truth and radical transparency. What I mean by radical truth means we can talk about whatever weaknesses are, who's good and bad at what, and so on, and bring all those things, problems to the surface. And then radical transparency, so everybody in the company can see all of this stuff going on, so there's no spin behind it. That's what's going on. So as we're working our way through this, Greg and I have been working together for 20 years. It's also very exaggerated because you make it Greg and I. There are some fantastic people. You know David McCormick,
sure.
Eileen Murray. Bob Prince has been with us for
Your
30,
other co-CIO, yes.
30 years. We have a whole team of people. It's a company of 1,500 people. Okay, so if it's almost a caricature that there want, okay, there's one, there's a caricature story which can be painted out in the media as being this thing that it's not, right?
Well, this is precisely why I introduced the question, is because I think it's important for you to clear the air.
Thank you. Thank you for giving me the chance. But that's what's happening. In other words, okay, here's this drama. Well, no. Do Greg and I disagree on some things? Yes. And also, how much of it there's David McCormick who might disagree on things.
And Eileen might disagree on something.
Well, we have a process for working ourselves through that. When I started my transition out of management, I'll always play the game because I love the game. As long as I'm welcome at Bridgewater, and they let me play the game, I'll play the game. But as far as the management part and that transition, we figured it's going to take a while to figure out how it works, and that's what we're going through.
One last question for you, Ray. I'm curious to know, because we talked a lot about the machine, we talked a lot about cycles and how the economy works. What role does politics play in that? American politics is attracting an enormous amount of attention. 2 days ago, we had Super Tuesday. It seems as though Mr. Trump is on his way to winning that Republican nomination. Things could change. Do you have to recalibrate your models to account for things like that?
I'm going to take the first part of the question rather than the recalibrate part of the question, just to be answering. If you go on the web, YouTube, I'll plug for there. I took 30 minutes to say how the economic machine works. And
it's a great video.
So it's on YouTube. It's 30 minutes, and it'll explain everything I know. And basically what happens is there's a part in a cycle where there is tension. And when you get to this phase of the cycle, there is tension between the haves and have-nots, and also there's a frustration with government. And what's happening in the United States is not very much different than what's happening in Spain with Podemos, or what's happening in many countries, that there is a frustration. We have a situation in which emotionally charged individuals who may not be well informed in choosing leaders might select leaders who are not capable and are emotional themselves. And if that happens in these countries, which is more prone to happen in these circumstances where there are these tensions, then that means that you get a type of leadership which handles the situations worse than if you had more capable, more moderate type of people who understand how the machine works and how should they deal with it. So whose hands it's in is important.
Yes.
Okay. And how fragmentation exists. If we're one group fighting against another group, it's going to be bad. if there is, in a sense, a moderation and a bringing together of people in terms of a common mission and and thoughtful disagreement, while we're talking about thoughtful disagreement, if you could work your way through to get at the right answers, then this is all manageable. So politics does matter. In answer to your question of how we deal with it, we measure what their actions are. And based on their actual actions, then we make our responses.
Ray, I want to thank you very much on behalf of Bloomberg Television viewers, radio listeners worldwide. It's been such a pleasure here at the University of Texas. Ray Dalio, he's the chairman, founder, and co-CIO of Bridgewater Associates.